Hey guys, Dave Keller here with Market Misbehavior. Today I want to talk to you about the three directions that the market can take. Because a lot of times we tend to think of the markets as having a binary outcome. It either is going up or it's going down. But in reality, the market can go three directions. It can go up, it can go down, and it can go sideways. So I host a closing bell show on Stock Charts TV called The Final Bar. It's every weekday after the close, and I have a lot of guests coming on, expert strategists, technical analysts, and so forth. And over the last couple of weeks, I've had people ranging from very bullish, expecting the S&P 500 to go to 3,600 plus by the end of the year. I've had people that say the market is going to not just test the lows from mid-February, but even break down and go further down in a grand super cycle going lower and lower. So how can we have such extremes of opinion right about now? What I want to do is break down very quickly the bull case, the bear case, and the sideways case. Talk to you a little bit about why people don't tend to expect the sideways option, that third option, and then I will give you my take on which one of those three I think is most probable for the coming weeks, coming months for stocks. So what makes the bull case right now? Well, the case for stocks going materially higher from here is this. We have had a huge breadth improvement from the market lows. At the lows in February, you had 0% of the S&P 500 trading above its 50-day moving average. Now you have over 70% or near about that on April 30th. So you've had over half, almost over 2/3 of stocks in the S&P 500 have gone from below their 50-day to back above. So you've had a broad rally. It's not just a small handful of names that have improved. It's actually a lot of names. It's the average stock has done better. And not just that, it's, for a while there it was the defensive mega cap tech consumer sort of led environment, the MAGA stocks, the FANG stocks, whatever you would call the Microsoft, Amazon, Netflixy types of things. Those are doing very well and performing well regardless of what was happening. But now you're actually getting a bid for the really beaten down names. Things that have improved are things like airlines, energy stocks. Even when oil is going down, you have people buying energy stocks. That is people buying into the fact that the market's not going to go materially lower from here. They're betting on things improving, more broadly speaking, is the idea. What's the bear case from here? Well, we've rallied about 61.8% of the way back up. That's after a 30% decline February to March low. You retraced over about 2/3 of the way back up. Well, not quite there, but between 50 and 61.8% of the way back up, which is pretty significant. The challenge is this looks like a classic bull trap, right? A huge sell-off, which happened at the beginning of the Great Depression, happened in most major bear markets. You have that initial sell-off, what is a disbelief phase where people can't believe the market's going down. Then you have this bull trap, this rally that comes in very low because people buy in on the weakness, they push it, and then start to think, they start to believe that this actually has staying power. They believe that the low is in, and they've bought in beautifully, and you have this fear of missing out if the market goes to new highs. And the challenge is once all those buyers have done their buying and they've gotten into the market, there's no one left to push the market higher from there. And so you get a bull trap or a bull move that has sucked a lot of people in, and then there's nowhere to go but much further down. The bear case, not just technically, I guess the macro perspective is, as I think a lot of bulls are expecting the Fed, they've made it clear the Fed is going to come in and be the buyer of last resort. They're going to provide support and buoy the economy, the markets as much as they can. But again, the bear case is that's not enough. People don't believe that that's going to help because it's not about what they're doing that's causing the market rallying. It's people's expectations of what that's going to mean. If they don't believe that the Fed has the ability to provide that support, then the market can go down much further from here. It certainly could happen. So what's that third option, the sideways option, and how would that actually work? Well, to be honest with you, the sideways option implies that there's a balance between those two forces, the bullish camp and the bearish camp. And again, based on conversations I've had, I see people making valid arguments for the bull case and the bear case and backing it up with legitimate support. They're explaining and justifying their outlooks pretty well. I think the evidence could support either case at this point. And so I think the sideways, the way that materializes is if there's a balance. When the market sells off, there's enough of a bid, there's enough of a disbelief that the market could go materially lower. There's an expectation the Fed will find support and or create support by being the buyer of last resort. that prevents huge downside. On the other side, when the market gets too frothy, if it gets too high, people start to think, is it really legitimately fair that the market should be going to new highs in the face of all the coronavirus issues and all the challenges companies are going to be facing for months, just trying to unwind or get back in up and running to full strength as they were a couple months ago? It's unrealistic to think that might happen so quickly. It certainly seems that it's going to have to be a longer road to go. And so if we get too high, people will start to realize that's unrealistic and too euphoric, and they'll take profits or take short positions. That's what will cause the resistance that a lot of people are expecting. So what we could have is sort of that third option, that backing and filling option, the balance between the two forces. And even though we might have a pretty wide range, in the end, we've gone nowhere directionally. It's more of an equilibrium. So having described those three directions, and I would think for yourself, how would you see yourself fitting into one of those three? And don't forget that third option of sideways. What do I think is the most probable? Well, if I had to put them in order of probability, I think option 3, sideways, would be number 1. I think option 2, the bear case, would be number 2. And then the third, least likely but still possible, is the bull case, going beyond the February highs. And here's why. I think the sideways option would not have been my number 1 choice even a couple of weeks ago. But the severity of the move out of the lows, how so many stocks that I would not expect to rally in this environment have been rallying. People buying into the idea that these stocks will recover, will be able to get through this coronavirus recovery, reopening of the economy period. The charts are certainly suggesting that there's an interest in buying when stocks get to that weaker level. That argues for more of a range-bound period. Option number 2, the bear market rally, and further downside. I think that's the second most likely option, and I still think it may even be number 1. I'm sort of almost evenly between the first two. I think the characteristics that we've seen now as a behavioral analyst, looking at crowd psychology, market behavior, and trying to get inside the head of other investors, this certainly feels like a rally driven by FOMO, the fear of missing out. It has the characteristics of a bull trap, of that initial huge rally that no one thinks would be as quick and as big as it has been. But that's happened before. That's how bull traps usually play out. That's that first rally out of the first leg down. So it looks a lot like the second leg of a multi-leg downward process. And then the third option is still a possibility, and that's why I think, to be honest with you, charts are so important, because you don't have to know the answer. You certainly want to be positioned a certain way and have a point of view, but in the end, you have to trust the charts. And so for me, looking at a long-term trend following model, combining the tactical time frame, the short-term fluctuations, the medium time frame, looking at a couple of months to a couple of years, and then the long-term time frame, understanding the long-term trajectory of the markets. I think if you look at charts and use them effectively, you should be able to navigate all three of those directions pretty well. I hope you found this to be a helpful description of the three market directions. And as a reminder, don't forget, don't limit yourself to bullish or bearish. Remember, it can be up, down, or sideways. There are three choices all the time. If you found this helpful, I hope you check out some of my other videos. And thanks so much. Be safe. Bye now.